Traders, what is trend following and why it's the big fuss about it? I mean, everywhere you turn, there it is. That's what we're going to talk about today on episode 18 of the Independent Quant. I'm the host and founder of the Independent Quant, Luis. I am a trader just like you. This podcast is for informational purposes only. I make no guarantees of success or profitability. And with that, let's just jump right into what is trend following. So in this episode, we're going to do a deep dive in everything that is trend following. But truly, before we get too far ahead, I definitely want to dedicate this episode to the memory of Bob Dunn. Bob Dunn did an amazing thing for myself. I signed up in 2016 with my then girlfriend, now wife, with this trading academy, the online trading academy, OTA. This podcast isn't sponsored by them at all. Just want to express what this is, because this is a very important episode for me. I signed up with them in 2016, went through their training program. I eventually decided in 2018 I was done with my job. I didn't want anything to do with it. We had our first son in June of that year, and I made the commitment that I was going to leave my job and start trading. So with that came a commitment to sign up for the largest package that Online Trading Academy offered, and we signed up for this course called Riding the Wave, and it was being put on by Bob Dunn. And I live in the greater DC area. This was in Austin, Texas. My wife and I, we jumped on a plane. This was November of 2018. Went to do this course with this gentleman by the name of Bob Dunn, and it completely changed my life. He just his approach, being able to spend that much time with a trader that had been successful as long as he had, for decades on end. Great personality, Chicagoan, born and raised, just like my wife. And just being around the group of traders that we were there, it was an amazing weekend. His approach to the markets, just being around that much energy with the people that I was in that room with. And then the follow-on courses that I had with him, follow-on sessions, really just completely changed how I approached the markets. And it made me appreciate technical analysis that much more. I embraced it. I studied it extensively. I invested into Michael Covell's book, which is Trend Following, which is considered one of the Bibles for this type of trading. But on top of what Bob Dunn did for me, just from a personal and a trader aspect of it, like I said, when I was in that course, I would come to meet 3 other people that would become just part of my family, right? We've to this day, now, what is this, 6-7 years later, we're still in touch. We are on our own little trading group. I bounce ideas off of them. Back in 2019, when I started talking about, hey, I want to start getting more into algorithmic trading, they fully supported me, and all these years they've always been there and have had my back. And all of that has come because of Bob Dunn, and even this effort here at the Independent Quant, because of the support I've gotten from, my trading family, is, where it's come to be, So all of this, I've got everything to thank for to Bob Dunn. He's no longer with us. He's passed away several years ago, but he's impacted my life, the lives of so many more. This episode is dedicated to his memory. I hope, that you get a lot of value out of this episode. And really, I hope that with the Independent Quant, I get to at least achieve a fraction of what Bob Dunn did for me. Do that for all of you that are listening, and through this podcast and through the Independent Quant. That's why all this exists. It takes a trader to make a trader, right? So trend following, what is it? Trend following is, if we take, essentially, it's a very simplistic strategy or concept, very difficult to pull off, but one of the most successful trend followers are the turtle traders. This is, you can look up the book by the same name. I believe Michael Covell also authored that book. They use donkey channels. This gentleman grabbed novice traders, taught them a set of rules to identify when to enter a market and when to get out of it. And ultimately, the 3 basic concepts that we're trying to achieve with trend following is, we're trying to identify the start of a trend, we're jumping onto that trend and staying on that trend, and then getting off that trend when the trend is coming to an end. So those 3 things: identify a trend, stay on the trend, get out of the trend when it's over. Sounds very simple. It can be very, very difficult. But that said, Trend following comes under many different names. Given the finance, we can't call any one thing by one name. So some people know it as trend following. Some call it momentum trading, though there is another strategy called momentum trading, so it can get confusing. There is a certain segment of people that call this time series momentum trading. The end of the day is prices moving in a certain direction, be that up or down, and you're riding it in that direction until it shows that it's not going in that direction anymore, then you get off. So that's trend following in a nutshell. And it has made many, many successful traders, countless, especially if you study on the CMT, that's the Chartered Market Technicians course put on by the CMT Association. I think that's a fabulous resource. It's all within the technical analysis field, which, like I've told many of you, that's where I come from. It explains how many people have actually made an absolute fortune off of trend following and momentum trading. So it's all really rooted in this concept or this statistical analysis that the market tends to do what it's already doing. A lot of great work has been done to identify trend following. On that note, though, there is also those that claim that there's no proof that trends exist, and this is within the academic realm. I'm not going to waste my time with those. You don't need a PhD to look at a chart and understand that there's impulsive moves in the market on the regular, and yes, there are trends, right? We're not going to get into the math of that. Now, where do trends come from? This is important because for us, our stance when we look at the markets and we look at a chart specifically, we look at all those bars, that show all these transactions and they're going up and they're going down. We define those movements based off of greed and fear. And by we, I mean technical analysts, which I'm going to, for the sake of this podcast, I'm pretty much going to say is a subset of quantitative trading, right? It's not in the real world, but it's my show, so I could say the way it goes. So it is the story of greed and fear, right? So price moves between support and resistance. So it goes from where the sellers are to where the buyers are. And that's where these price fluctuations happen. There come those moments where, we are human, we are social creatures. We do get on herd mentality. So aside from our personal greed and fear, we will go to those products that are demonstrating a propensity to have the activity that we think is going to happen. And it happens because we are all participating in it driving the price either up or down on whatever symbol we're talking on. So there's a herd mentality reason for why trends happen. There's the fears of people have of fear of missing out. They see price moving. They don't want to miss out on that. They jump on, even though it's probably not the best time to jump on, but that's fine because it further pushes prices up. And if you did your homework correctly, you would have jumped on much earlier than these untrained so-called traders do, and you're able to capitalize on their profits. There is reaction to the news, right? If Warren Buffett was to declare that he was buying company X, Y, and Z, or he was selling from Berkshire Hathaway companies A, B, and C, we would see a corresponding move in the prices of those companies, whether or not it was warranted or not, right? It's people have their perceptions as to, what the greatest investor in the world thinks on something and act accordingly. Well, it doesn't have to be Warren Buffett. Really just about any news will drive that. As I'm recording this, we're going through a series of trade wars with tariffs being jacked up and dropped, which is causing a lot of volatility in the market. That is the market reacting to news. That is the story again of greed and fear. And that's what we as traders don't want to be a part of. We don't want to be engaged or feeling the same greed and fear that these untrained traders again are having. We want to have a systematic approach so we could capitalize on their greed and fear. So that is a kind of short synopsis of where trends come from. As far as the performance, like I've said, there's a lot of data out there. Given that some of you may not be watching this via video podcast and may be actually listening to the audio, I'm not going to share any visuals in this podcast to show any returns, so I'm not going to bother discussing them, but you can for sure Google returns for momentum or trend following strategies and find that they tend to be the higher yielding strategies available to everyone. The challenge I would say is why they're not more popular is they tend to not have high win percentages. If you're winning around 40% of the time, then you're doing good as a trend follower. That may sound trivial to those of you that are professional traders like myself, but it takes a huge mental shift for folks to embrace the idea that you can be wrong 60% of the time at something and still make a fortune, right? Even though, I'm Dominican, so I love baseball. I think everything we need to know about statistics you learn just by watching baseball. We know that if a person or batter was to go to the plate and strike out 7 times out of 10, guaranteed, not knowing when those 7 times are going to be, but then the other 3 times out of 10 that batter steps into the batter's box, all they do is get a base hit, make it to first, make it to second. That's it. That's all they did. And they would do that day in, day out, game in, game out, month in, month out, year in, year out. We're talking about the greatest batter in all of history, and that batter is batting 300, right? That's the mentality you got to have with looking at trend following. Yes, you're going to lose most of the time, but if you're following your rules and you know that the strategy you have is sound in the long run, right? This is what makes us professional traders is even if you're day trading, we are always looking at our strategies in the long run. In the long run, that money is going to come back to us and then some, right? Now, when does a trend following strategy work? It works when the market's trending. It's nonsensical to even have to say that, but yes, if the market is going sideways, not a strategy that really lends itself to that, right? And why I'm not even more decisive in that is sometimes there are micro trends that are happening. Just because we're looking at a daily chart and see this, the S&P 500, right, as an example, kind of stuck in this sideways channel, doesn't mean that there's no trend, right? If you go into the intraday charts, there is a range. That market is bouncing off support and resistance. It's going up so much and then coming back down. There are trends within the day that a trend follower can absolutely capitalize on, right? I've done intraday trend following trading. Point being is it still needs a trend, and you still need to be able to identify a trend. If you're looking at a choppy market, not going to work, right? Now, what kind of trending market works? Doesn't actually matter, right? It's a market that's going up, you'll make a good deal of money doing trend following. If it's a market going down, you'll make a good deal of money, if not more, right? Because there's this saying that the markets take the stairs up and the elevator down, right? Markets tend to crash faster than what they can rise. So if you are able to catch a market that's showing weakness at the very beginning, either short that market if you have the permissions to do that with your broker for equities, or usually most of us can do that in the futures market, no problem, as long as we have a stop in there. The brokers will allow us to do that. Or you buy a put. And for those of you that don't know, that's a type of option, and ride it down, right? There's no trend that we can't, there's only 2 trends, up or down, but we're not limited as to which one we can choose. We can ride either trend in either direction. And that's the beauty of trend following, right? So how do we apply trend following? There's probably as many ways to apply trend following as there are trend following traders. For myself, I use a lot of moving averages to identify those, but I marry those moving averages along with price action, where I'm looking at breaking of support and resistance, a clear move of maybe it's bouncing off some type of low, significant low, or some type of significant high, which may not always be the lower time frame support and resistance that I was referring to at the beginning of that statement. But I'm looking for those indications that a trend is developing. And that's one way. So that's using moving averages. Moving averages in and of themselves usually do not provide enough information for you to be able to take a trade for trend following, but it's a start. From there you can add extra rules to that. The turtle traders, they used Donchian channels, which was, I believe it was Donchian channels. I could be wrong on that, but it was a channel of the kind. That channel, what it allowed was it would look back a certain period of days or weeks, whatever time frame you're trading on, and it would look to see if a new high or new low was made that pretty much broke that channel. They would enter in that direction, and they had an entire systems-based rule structure that would tell them how to phase into that and how to phase out of that trade to manage their risk. So finding rules for trend following strategies, not that difficult. Additionally, there's indicators out there that help us do this very same thing. Now, again, this podcast is not sponsored by anyone, but sharing kind of my history and with this. When I learned of Bob Dunn, I was getting into trend following a lot. I was like, it'd be great to have an indicator. I still wasn't a robust technical analyst, so I invested in this indicator called Able Trend. It's a big deal. It's a won many awards for a long time. It's a prominent indicator. I used that for a couple of years. I even purchased it. I had a couple of years where I leased it, and then I eventually did purchase it. Since then, now it's been several years since that. I have not renewed the membership with that. I've gotten comfortable enough with my technical analysis skills that I've pretty much divorced myself of that indicator. Point being is there are indicators out there that you can use to inform when you can enter a trade, how to manage that trade as you're going through it, and when to get out. That was something that Able Trend was able to provide me while I was learning how to do this without the aid of an indicator. Now that we're moving on to quantitative strategies and looking at doing algorithmic strategies, a lot of what I've done still applies, right? We can still use moving averages and pair that with other indicators and give the algorithm the instructions to make the determination of when to enter based on the conditions of those moving averages in relation to any other indicator or restrictions that you put on it so that it's not taking trades on a sideways market. And there you go. Now you have a simple based rule for you to be able to enter a trend following trade. Now that's it. You're following the simple rules. Another thing that you definitely need is to find an adequate market. Not all markets are ideal for trend following. Some markets that range, maybe a utilities company or something like that, that doesn't have much dynamic price movement or is consistently ranging within a price point, not something that you would lend itself to trend following. But you can usually do it in any major market. So like in Forex, looking at the euro dollar pair, that might be a good one to take a look at. I've done some trend following there. Not as many trends usually on that one, but you can usually go down off the daily and be able to get some good trends off of that that you can capitalize off of. If you're in commodities, these tend to be, in my opinion, the gold standard for any type of trending strategy because they're real. Right we know when soybean gets planted, when it grows, when it gets harvested. I mean, I don't actually know when that happens, right? Let's not be kidding. I don't know anything about farming, but we can figure that out on the chart. There's seasonality to it, I guess is my point. Because it is a real physical product that is bound by the weather and the earth and things that are non-human, you can, we can say, hey, this is when the price of soybeans is going to be low. It's going to increase during this part of the year. It's going to then drop off because it's out of season and it's not being planted and harvested and all that. There is a cycle to it. There's movement to it. There's tends to be that trend to it. It's rarely caught in a sideways market, right? And so commodities are a very, very big one to take a look at, especially agricultural commodities. They tend not to be as traded as heavily as some other commodities, but that said, soybean comes to mind because I have traded soybean, mostly because it is one of the most liquid futures agricultural products to the point where it is liquid. It's not in a liquid market. It does trade, for my liking, fairly odd hours compared to the rest of the market. I don't remember what those are right now as I record this. I'm kind of going off the cuff as I sharing all these thoughts right now. But yeah, it's commodities. If there was a place where you could say start to implement your rules, try with commodities. Next are the equity indices. Those are the bread and butter on all this. I have, over the years, focused a lot of my trading on the S&P 500. That was everything from swing trading to day trading to options trading. The S&P 500 is very liquid. It does go into trends, even if they're micro trends. If there isn't a larger multi-day trend or a weekly trend happening, there's usually an intra-day trend happening. And that's, if anything I can recommend, is if you're getting into a strategy, just choose one symbol that is you have reasonable belief to think that it's going to work in that symbol, and just work to that symbol, and amazing things will happen. For example, with S&P 500, I can exploit trends either using the SPY, which is the ETF. I can go into the futures, which is ES, or I can take options off the spider if I can't, if that becomes more feasible. If it's stuck in a sideways trend, I can maybe sell puts and calls against it. That's not what this podcast episode's about. I'm just trying to drive the point is for you to get into trend following, just choose a symbol and just watch it. Try to figure out how to trade it. Don't try to figure out everything all at once. But the equity indices, very much so. So the equity indices, just for thoroughness, that's the S&P 500, the NASDAQ, the Dow Jones, and the Russell. Those four were a great start to get out there and start trying your hand on trend following. Now, trend following, like I mentioned, there is the risk of trading in a sideways market. You could be getting signals that are false signals that will eventually chop you up. But another risk that we have to manage, just like any other strategy, is risk management. Now, a pure trend follower does not trade with targets. You can trade with targets, right? It's your world, your life. But for sake of baselining all of you and kind of telling you what the standard, if any, of a trend follower is, we trade with trailing stops. We don't like to be capped as to how much money we could make. And there are rules as to how to move your stop along the path of that trend. The Turtles had theirs. Bob Dunn gave us his as to how to enter and follow a trend. You can come up with your own, but ultimately it is moving at your exit condition. It can be arbitrary, which is the way that Bob Dunn taught us. It was a function of profitability. We would look at how much profit there was in there, and we would progressively take a certain amount. You can definitely do this by way of looking at support and resistance and moving your trailing stop to those positions where have support and resistance. The big thing is, and I love this from Bob Dunn, is you never let a winner turn into a loser. So as you enter a trading position for a trend following strategy, if it's going in your favor and it's gone in your favor a certain amount, I definitely like to put it at more than break even. Bob used to say put it at lunch. No, take lunch. Well, for me, that's lunch plus covering the trading costs for that trade, because you don't want to have this really great winning trade turn around and stop you out, right? You're just going to eat yourself up. But all this to say is you need a sound trading risk management strategy. One of the things that also can get you in trouble, and this was a big one, especially when I was implementing Bob Dunn's strategy, is the matter of over trading. It is very easy to do with trend following. Over trading is entering into just way too many trades. It's a fairly simple term, but what's too many trades? Intraday, usually the market doesn't give you more than 4 opportunities to enter a trade, especially a trend following trade. So if you've taken more than that, you're probably over trading, right? If you didn't get it the first time, maybe, just maybe, it wasn't actually the start of a trend. If you didn't get it the second time, it probably most definitely wasn't the start of a trend. And it's reason for you to stop trying to capture it and look for another indicator other than that initial indicator that you had to enter your trade. But you need to have that structure in, because if not, like I said, that sideways trend that can just destroy you. But risk management does not take a backseat with trend following whatsoever. So you need to have a plan in place. So trend following, for me, this is the king of all trading strategies. As I trade my algorithmic strategies, I look to develop more and more what are in essence momentum strategies, which for me are a subset of trend following. They are just a great way to really just get good money out of the market. It's just a nice explosive move, maybe capture a portion of it, or definitely just ride it as far as you can. If that was all really appealing to you, go ahead and, I'm going to plug Michael Covell's book. I get no money out of doing that, no recognition for having done that. I think it's a phenomenal book. I own it both in hard copy and in digital. I've read it. It's a massive, massive book. It is absolutely huge. I would say the first half is where all the quality material is. Everything after is more justification and explanation for why trend following is as powerful as it is. So I would say the latter half isn't required reading if you're interested in just learning about trend following. But the first half most absolutely is. And I point you to that book just because it is just so well done. With that, if you're looking to get more and understand more on how to implement a trend following strategy using algorithms, then you're in the right place at theindependentquant.com. Head on over, download our free resource on how to get started with quantitative trading. Look forward to seeing you all on our next episode here of the Independent Quant podcast. Until then, keep it green. This is Luis, everyone. Out.